And boom, this is the very first Praxis Wealth Management Mastermind, which feels good. It's awesome to have some lovely humans here today. Our guest, very first numero uno, is Carsten Hood, who is a financial advisor with Redbud Advisors down in Austin, Texas. He's got about 2 years of experience helping to organize the finances of high net worth families and family offices. And today, Carsten's here to talk a little bit about principles of wealth management and also ways to very cleverly minimize your tax liabilities, which I think is something that everyone on this call would very much appreciate. So, Carsten, curious to learn a bit more about just kind of like what got you interested in the first place, like self-education with personal finances and wanting to take that to the next level professionally.
It's funny. So I actually have a computer science background, and that's what I studied in college. But it was around then that I got into economics, free markets, political philosophy, and out of college had a few jobs, was bouncing around. I wrote patents for a while. I was a programmer for a while. And I really just stumbled into an internship with a family friend who's a financial advisor, and worked my way up over the last 2 years to where I am now. And I love it. I mean, I really do. It's more varied work. I hate taxes. I know we have lots of people who love taxes here. A big tax guy. And it's fun helping people like just navigate that space, avoid taxes, protect wealth that they've, built, like spent their whole life earning and building, and helping people kind of protect it, grow it, is super fulfilling.
That's awesome, bro. That's perfect background context for what you're about to present on. And I gather that you've even got a little deck for us today, right?
Yeah, I just, just the last hour I threw something together, but I don't know if there's a way if I can share it or.
Yeah. So I just made you the host actually, so you should be able to share your screen.
Can you all see that? Oh, here we go, share.
Yep, there it is.
All right, y'all can see it, sweet. Hold on for just a second. Got some notes up. Well, first off, thanks everyone for being here. Thanks, Nick. I recognize some of y'all from Facebook. I've met some of y'all in person. So everyone I haven't met yet, good to meet you. I know this is like a super cool group. What I'll do is kind of start with a bird's eye view of some wealth management principles, some investing principles, and then get down to some more specific, more actionable things that everyone should be doing. And I mean, everyone being I understand we're all generally pretty young, entrepreneurial, love taxes, that sort of thing. So also, I'm gonna try not to assume everyone or anyone knows really anything, because I don't like when people do that. I mean, every space is a niche. I really didn't know anything about even retirement accounts or lots of financial concepts just until the last few years. So I want to kind of cover all the bases. Feel free to jump in and interrupt if there's a connection issue or any question or something you want to point out or correct. But I'll jump right in. Oh, and also I'll add, as Nick said, I'm with a little firm in Austin now. We manage money for about 30 wealthy families, anywhere from a couple million net worth to 100, 200 million net worth. And we're helping them not just with managing investments, like a lot of financial advisors, but also with estate planning, with tax planning, financial planning, retirement, intergenerational wealth, all sorts of stuff, just helping them navigate kind of every part of their financial world. So, I mean, that's what I do. And so hopefully, I mean, that's given me enough experience, and I'm still very much learning and feel pretty new. Hopefully it's given me some stuff I can share with you guys. So starting with just some principles, I won't hang too long on the warm and fuzzy stuff, but at our firm, what we start with is with new prospects, potential clients, is what are your goals? Like, first, what does money mean to you? And then what are you trying to do with it? Are you trying to retire early? Do you want to support a family? Do you want to live somewhere, buy a house, pass it down to your kids, give it to charity? There's actually a lot of different goals. I mean, building wealth is always kind of an intermediary goal, but what's the goal after that? And the way we like to answer the first question is generally to say that money is a tool. And I imagine a lot of y'all would say the same thing. I think Nick said the same thing when I asked him. It's a means to an end. It's not the end in itself. So you have to think about the ends before you can really develop a strategy. Here's some principles from this guy, Stuart Lucas. He's like a fourth generation heir to a big American business fortune. Really smart guy. And the only thing I want to highlight here is how much these principles focus on people. And like the rest of my talk, I'm not going to be talking about relationships and people. I'm going to be talking about finance. So I might as well just get it out of the way and say, people and relationships are going to come first with all this stuff. That's going to make the biggest difference. And that's usually the goal. He's talking about aligning family, creating the right culture, using your family's resources to the fullest extent, like respecting people's independence, empowering them, some kind of investment principles, and then lastly, developing, future leaders. Next, there's a lot you can't control in wealth management. Taxes is a big one. It's really sad. Sometimes it feels like everything's about taxes, just capital gains and all the business, corporate taxes, income tax, property sales. A lot of finance is navigating taxes. There's also regulatory risk, political risk. You never know when stuff's going to change on you. There's some fundamental stuff in the economy that affects market prices, but there's also just the business cycle and the fact that the government controls the money and can create it pretty much out of thin air, and that throws everything out of whack in a way that it's really hard to understand. And so it's just something to be aware of, but you have to appreciate what you can't control. It's kind of that Stoic principle of focus on what you can control, which is, your investment plan, your psychology and mindset. A lot of this is about psychology when you're talking about building wealth, maintaining it, investing. You don't want to panic. You don't want to just follow these psychological biases like, oh, I'm missing out, or I'm not following the herd, or this kind of thing. I really like the book, what's it called? Influence. I forget the subtitle, but it talks about these principles of scarcity, just, oh, everyone's doing it, so I need to hop on board. And a lot of the times when everyone's doing something, it's the time to do something else. That's how you make money, is by doing what people aren't doing. Other things you can control, I'll touch on some estate planning stuff, just kind of the culture and attitude you bring, the people around you, fees. When you're dealing with businesses, advisors, insurance plans, or whatever it is, you need to be on the lookout for fees. Fortunately, a lot of the stuff, fees are kind of getting competitive and going down. And then, of course, saving versus spending. Now, also, it's okay to outsource. This is a super complicated space. The fact that y'all are here, tells me y'all want to benefit from other people's knowledge and from each other's knowledge. So probably don't have a problem with this. You want a good CPA to help you with taxes. You want, if you're dealing with estate planning stuff, a good estate attorney. And then, what we do, we're financial advisors or planners. That's what I am. And some people like to get into the nitty gritty of investments and taxes and do it on their own, and great. And some people would rather do other things. And in that case, I think feel free to outsource.
Quick question.
Yep.
Are you guys investment advisors or financial advisors?
Financial advisors, really. I mean, we always argue about what term we should use, but usually investment advisors are more focused on just like kind of what people own, where we think we're doing more comprehensive stuff all across the board.
I just wanted to clarify because investment advisors have a different licensing.
Yeah, I gotcha. Yeah, I'm licensed just as of December as a financial advisor. Basic estate planning point, just if you own anything really, you're not a minor, you can go online and set up a will pretty cheap on one of these websites. It's all kind of commoditized now. Of course, if you're successful, your business is growing, revenue is growing, whatever it is, don't wait to think about your estate and what happens if you die and what you want to do with it, and start talking to attorneys. I mean, especially with Uncle Joe, the kind of like ideas he's throwing around about estate tax, death tax. There are ways to get around that. Wealthy people will always find a way to get around taxes, but you have to start thinking about it. Now, all wealth comes down to spending versus saving. One of the main principles in this book called The Millionaire Next Door is just to set aside 10% of the money you make. I mean, whatever, if you make it just every 2 weeks or however you're making money, set aside, I mean, if you're struggling, maybe 5%, but really, I feel like there's not an excuse to not just set aside 10% of the money you make, unless maybe you're throwing all of it back into yourself or your business or something like that, where you're reinvesting it. You should be saving. I mean, if you can't do that, you're probably spending too much. Now, saving isn't enough like it used to be maybe 100 years ago. You have to invest it too. So I'll get into some investment principles next. And I mean, I say that just because money loses value because the government's creating so much of it. I mean, that's what I mean by that. So some fun principles of investing: don't lose money. I mean, people like to pretend that risk is volatility, and like, don't tell the government regulators I said this, but I think that's really stupid. Risk really is the probability of losing money. I mean, Bitcoin's volatile, but is it risky? I mean, maybe, but what does that have to do with, I mean, some stocks are volatile, but the risk of losing money is really the one you want to worry about. And you just never want something to go to zero. That's a huge effect on your bottom line. Next, invest in things you understand. You don't want to be diversifying just for the sake of diversifying. You want to focus on things. I mean, that has its own risks if you're investing in stuff you don't understand. I do think it's good to have, I mean, eventually to try to get most of these categories. Stocks, real estate is great. Alternative private investments just means like your friend's business deal or private deals that aren't on the public markets. If you're ever exposed to something like that you understand really well, that can be a really great way to keep money and make money. Of course, crypto, precious metal. Another principle is invest for the long term. That's a huge advantage we have over institutional investors like big companies, fund managers, hedge funds. They're generating monthly, quarterly, annual reports all the time, and that makes them think short term. Like they want to show good short term performance. And we don't want to be thinking monthly or quarterly or even annually. We want to be thinking decades. And that's a big advantage that little guys like us have, investing in markets. So, I mean, the way my dad puts it, actually, he's like, I want to be able to go on a 10-year vacation, which he's joking, and come back and still be happy with where my portfolio is. This is another line of his: the market is a machine that transfers money from the active to the patient. Actually, just threw in this next slide that shows, it's just interesting how bad active Wall Street managers are at managing money. I mean, people will pay them 1% of all the money that they manage every year and get performance that's worse than just putting it in like the S&P 500, just putting it in the stock market. Like, I mean, this is an old number, 2018, but it hasn't changed. Like every year, these guys, the vast majority of them are not doing as well as just passive index funds in the stock market. So interesting tidbit there. I love this point. This is super cool concept. Basically, I mean, Warren Buffett's quote is great. I'm not the biggest fan of Warren Buffett's politics, but he's obviously a genius investor. And his attitude is like, a couple times in your life, maybe 7, 10, 15, you get these opportunities unlike anything else just because of market cycles and political winds and whatever it is. And you need to be ready when that happens. You need to have the kind of the mindset, like your psychology, your resolve, and then you also want cash liquidity, which might not mean literally cash, but something you can convert to cash easily, like, I don't know, gold, Bitcoin might fill that role, so that you can jump when the market goes down, everyone's panicking. And if you know what you're doing, that's the time you can make a lot of money. And I think of just in my lifetime, I mean, we're all pretty young, but I remember the financial crisis. I had a friend's dad who he had a lot of cash already because he didn't know what he was doing in the stock market. So he just got lucky. He had cash. And then he also mortgaged his house after this happened and just went all in the stock market and made a ton of money. And that's just kind of a once in a lifetime thing. This recent crash in 2020, stock market went down. I had a friend who was also a financial advisor who mortgaged his condo and put it all into individual stocks, like all the industries that were really affected by COVID, like hospitality and hotels. And he just went all in and doubled his money in 6 months. Crypto, I mean, this is the one we all like really, I mean, wish we were a part of, or hopefully we're a part of, where, I mean, this is even less common than the other things. A whole new technology, a whole new opportunity. Either you're there for it or you miss it. And the good news is, I mean, according to this concept, there's going to be more opportunities like this. So if you're interested in investing, if you're managing any amount of money, it's just something to be aware of. Don't just follow the crowd, follow the news. Think for yourself and consider when one of these once in a lifetime opportunities might be available. Also, I think it's good to just have a plan, just have a good kind of concept of where your money is and what it's doing, where you're putting it as you make it, as you invest it. You don't want to be caught in a place where something changes and you're like, yeah, I should have been doing this, but like it's never got around to it. Be proactive about your plan, kind of stick to it. And if something changes, then you can change the plan, but you don't want to change the plan just based on psychology, just based on fear. You want to, if something changes, there's some real significant change, then adjust the plan. But I think, have a plan and stick to it, check in on it, that sort of thing. And, I just threw this in. This is actually a real client of ours, just an example page of the kind of stuff. I bring it up as an example of the kind of things to think about. Liquidity is this concept of how easy it is for you to turn your assets into cash. So this Navy is stocks and bonds. So they're very liquid. They can easily sell stocks and bonds in the market between 8:30 and 3 or whatever, and during trading hours, and they have cash. This is something to be aware of, like how liquid are you? Or do you own real estate, which is more like the illiquid? You can't easily get cash out of it. It's just something to kind of keep track of with your personal wealth. Asset location is another concept. I like to call it taxability, asset taxability, just what kind of accounts is your wealth in? I mean, I'll talk about this a little later, a little more specifically, but there's, taxable accounts, which is just normal, everything that the government can tax, which is just normal. I mean, that's just the world we live in. But of course, the government set up these special retirement accounts where it says, hey, if you use this type of account with your business or like an IRA, you can open it up really easily, put money in, and that hasn't been taxed. And when you take it out, and after age 60, around age 60, you can take it out, and then it gets taxed at that point. And of course, every time you're trading in that account, buying, selling stuff, you're not paying taxes that whole time. You only pay taxes when you take money out of the account. So it's a good little, I mean, it's the game. It's not like it's my favorite thing that we have to have these special accounts to avoid taxes, but that's the way it is. And it's a great strategy. Non-taxable accounts are the best. I'll talk about that a little later. So I'll pause here. Is there any other questions you guys have, or just anyone want to pipe up before I get into kind of actionable stuff? Also, has connection been an issue at all? Am I
Not at all.
pretty good with my, okay, it's my phone hotspot.
Good stuff.
So some specific things regarding stocks and bonds. This space, I mean, it used to be you had to like phone call your broker, your financial advisor, and pay them 1% of all your assets that they manage a year to buy stocks and bonds for you. Those days are older. I mean, technology has really changed things. Stuff's getting really competitive. You can go to these websites like Betterment. I was just reading about SoFi. I'm not very familiar with it. It just seemed pretty cool. And they'll just kind of, you can put in weekly a certain amount of money from your paycheck, and they'll invest it in a kind of diverse array of index funds, global stuff for you. And I mean, if you'd started doing that a year ago, you'd be doing pretty well right now. I'm sure a lot of the stuff is familiar to you guys, or some of y'all use it. Like Acorns is this app where it kind of just rounds up purchases to the nearest dollar and takes that difference and automatically invests it just the same way, in the same way that Betterment invests money that you give them. I like having a little more control. So you can set up auto investments where you dictate the allocation. You say, I'm going to buy a certain array of index funds, say. An index fund just being, a company will set up a fund that just buys a pool of underlying stocks, say that kind of, across the entire US stock market. So you can just kind of follow the market. And you can, on services, these are really common broker services, TD Ameritrade, Schwab. There are tons of these platforms where you can set up just automatic purchases of stock. M1 Finance is another one. Actually, M1 Finance is super cool. You can automatically take a fraction of your paycheck, send it to M1 Finance, set an allocation. Here's an example of one that I use, where I say, okay, every dollar I give to M1 Finance, 70 cents is going to go to this US stock market, 20 cents is going to go to developed markets like Europe, East Asia, 10% is going to go to this fund of stocks in emerging markets like China, India. And so that's just happening weekly, automatically. Great way to save and build wealth. By the way, is time flying by? I'm already at like 15 minutes, 20 minutes.
Yeah. So I would say it'd be great to have a little bit of time to do masterminding at the end of this. If you can wrap up in like the next 5 or 10 minutes, and we can always go.
Okay. Yeah, that's easy. I'll go through a little faster.
Perfect.
Crypto gold. Love it. So this is really good stuff. Retirement accounts, for those not familiar with this stuff, Roth IRAs are kind of the holy grail of saving money. Basically, these are the types of accounts that the government lets you set up. You can just go to TD Ameritrade, for example, create an account, say, I want to open an IRA or a Roth IRA, and you're allowed to give $6,000 a year right now to this account. With an IRA, you give them the money before it gets taxed. So you have money, you put it in this account before it gets to tax, and it gets taxed when you take it out. With a Roth IRA, it's taxed before you put it in, and when you take it out, it's tax-free, which is amazing. So really everyone should be doing that. If you make over 6,000 a year, you should put 6,000 in a Roth IRA. The problem, I mean, if you make over a certain amount of money, it's like 120, 130 grand a year, you can't fund IRAs or a Roth IRA, but you can still do this trick called a backdoor, where you put it into an IRA and then you backdoor it into a Roth IRA. So I'm kind of rushing over this, but it's something easy to Google or email me about or something if you're unfamiliar with it, because it's something everyone should be doing. I mean, if you're doing this every year, all of a sudden you have 100 grand, 200 grand in this account. You know, when you retire, it could be in the millions. That's, I mean, it could save you hundreds of thousands of dollars in taxes, just making sure you use these accounts. Similar for, I mean, I don't know how many of you guys like run your own businesses, or I know we're all kind of entrepreneurial here. Solo 401ks and SEP IRAs are probably some of the main things you're looking at. These retirement plans the government lets you set up for your small business. If you can do a Roth solo 401k, that's amazing. Like, that's the best thing you can do. So I would say check that out. If you're with any kind of small business, ask your boss about it. Ask your boss about, like, if you don't have some kind of 401k, make sure you're using it, you're maxing it out. I mean, if there's one takeaway from my blabbering, like, that would be it, is take advantage of these types of accounts. I'll skip over this. You know, that's pretty much it. There are lots of loopholes.
Could you maybe quickly, because I think this is something that not a lot of people know about, and I'm only very slightly familiar with it, is I think you touched on it, was the self-directed 401ks.
Yeah, so self-directed 401k is actually synonymous with solo 401k. And I mean, we even have a client, he has a business, he has a self-directed 401k and also a defined benefits plan. So he has both these accounts. Now you outsource this to some company that specializes in navigating the laws and managing retirement accounts for your company. So you just have to contact some business and say, hey, I want to set this up, help me. And that third-party group will tell him every year how much money he can put into these accounts. Like, you know, his business is generating revenue, he pays expenses, he pays himself, and he tries to put at least some of the money into his, you know, his self-directed 401k. And they'll tell him how much, and it's, I mean, it can be a lot. It can be, for a couple, you can have a spouse involved in it too, and you can put away like 100 grand a year.
And isn't there a special thing that you are allowed to buy certain assets that you normally couldn't with the 401k, right? Like you can buy real estate with it?
Yeah, absolutely. I'm actually pulling up my notes about this.
Yeah, this I think is huge for a lot of us, because it's like a lot of us are self-employed here. I mean, I'm not, but a lot of us I know in the group I think are. So that could be huge, because if you can invest in real estate with a 401k pre-tax dollars, like that's huge.
Yeah, I'm looking at how much. Yeah, a married couple can contribute 114 grand per year to these accounts, and especially if you can set up the Roth thing where you pay the taxes up front and then you put it into, that's what Roth means. It's like you're not paying the taxes on the end, you pay them like you normally would, then you put them in the special account, the self-directed 401k. Like you said, you can buy crypto, you can buy real estate, you could buy like a rental property or a apartment building or something, you know, a couple of decades down the line, and all of a sudden you're getting cash flow into that account, and you can start withdrawing from that account after age 60, and it's tax-free. The thing is, I mean, solo 401k is really for a sole proprietor. You can still hire, let's see, like 1099 employees. You can have contractors, you can have a partner, you can have a spouse, but that's it. You can't have like regular employees. So you really have to be kind of a one-man shop with just maybe some contractors under you. SEP IRA, I think, is a little more flexible and also a little simpler, where you can pay, your employees can also have these if you're a small business. But yeah, I mean, go ahead.
With the solo 401k, isn't it like you could essentially set up a personal, it have to be personally connected, or could it be through your LLC LLC that you do business with and then do business with other LLCs, for example?
That's a good question. I think there's actually a couple ways you can structure it. I don't think it really matters when I was reading about it, but I'd really have to check to tell you the details.
Yeah, because I'm just curious about the liability with the assets, right? Depending on what you're investing in, like how likely is it to come back to you? Are you protected if you get sued? Is your solo 401k protected? Like, I just want to know those things.
Oh, that's a good question, and I can't say. Maybe your solo 401k owns an LLC that owns a piece of real estate, and if someone sues you over that piece of real estate, it doesn't even make it up to the solo 401k because it's some intermediary entity. But I mean, that's something that's something to figure out with whoever's helping you run the solo 401k.
Yeah, it's super in the weeds topic, but I appreciate that.
Yeah, for sure. That's all I got, guys. I mean, the last thing I'll mention is just if you're setting up any kind of small business, there's lots of loopholes you can do. The one thing I'll highlight just as an example is qualified small business stock. If you're in a certain industry, you check all the boxes. I mean, you have to be careful here because you don't want to screw it up and get screwed by the IRS. But probably a lot of y'all are in technology. If you issue stock, if you're the original owner, you can not pay taxes on up to 10 million in gains when you sell the stock, say 5 or 10 years down the road or something like that. So I don't know all the details, but the point is there's some weird stuff like this in the tax code where you can save a lot of money just by checking some boxes, like asking an expert about it, that sort of thing. And yeah, that's the last thing I'll highlight. So appreciate it. I didn't mean to go so long, but
totally good. Yeah, I think that I learned a lot. It was a refresher in some parts and totally new information in others. So sincerely appreciate it, Carsten. And at this point, we can do like a little bit of Q&A if you guys have specific questions for Carsten, or you can just say like, hey, I'd like to ask everyone and get everyone's collective intelligence and input on a specific challenge or question that you have. And I can even model that a little bit as an example. So Carsten, I think that you'd agree that high yield savings accounts are kind of a joke at this point because the highest yield I've seen is like 0.5% at this point, but the rate of inflation on paper is already 3%. And in terms of asset inflation, it's something ridiculous, like 10 to 15%. So I'd be curious to you, Carsten, and to anyone else in the group, what vehicles are you aware of that you can park cash in, gain some yield that's not completely absurdly below the rate of inflation? Yeah, 0.5%. Way to go, Thomas.
Yeah, well, I think you're definitely right. I mean, I didn't even mention savings accounts and I didn't mention bonds. And I guess I could have mentioned them just to say that I think they're a waste of time.
Yeah.
It's just hard to make money with how low interest rates are. It's a good time to borrow money because interest rates are so low. So I don't know if that means mortgaging your house or saying, taking a loan against your crypto account, or you can even, if you have enough stock, you can take loans against your stock. There are different ways you can take advantage of low interest rates, but yeah, you're right. It's hard. It's really just hard to make money at all passively. Real estate is probably a great way. And then, I mean, stocks and crypto, you're just hoping that they keep going up. And I'm not going to make a guess because I have no idea if they're going to. I think they are. I tend to think crypto, especially in stock, but who knows what the ups and downs are going to look like. But I mean, real estate is a good way to preserve money, get cash flow, and alternative investments. The problem is just finding it and accessing it, especially when you're young and you might not have, the capital on hand.
I'm curious, Nick, when you're asking like where to park cash, like what would be kind of the level of flexibility you'd want, like liquidity? How quickly would you need it if you wanted to use it?
That's a great question. I mean, technically speaking, it wouldn't matter to me if it's available in the same day or like a week later or something like that. One thing that I am comparing options with is like decentralized finance protocols in the crypto space, as well as like these lending platforms like BlockFi and Celsius. So for those of you who don't know, There are already like financial institutions out there. You can park 10 grand in stable coins, which are 1-to-1 pegged to the US dollar, and you can get like 8 to 11% APY paid back in like dollar-based stable coins. So that's like 20 times higher than a quote unquote high yield savings account. The challenge is that you have counterparty risk with a centralized institution and you're hoping that they remain like solvent, right? So then with DeFi, it's like it's a very transparent protocol, and maybe there's more trust in that, but I'm just not familiar enough with it to feel comfortable. So those are some of the avenues that I've looked at.
One thing that I'm aware of is there's certain, you have to be very selective because not every insurance policy is created the same, but there's certain whole life insurance policies that after like a certain amount, you can either put a full amount in like a one-time pay and then borrow against it tax-free. And then depending, you have to be very, very careful again. It will pay the interest, so you would never lose the policy, but you have to be very, very careful and have to find the right kind of insurance person to get you that policy because there's a lot of shit policies out there.
Interesting.
I actually did that for a short period of time, and I know somebody who I believe is a very intelligent person on those whole life insurance policies. The only issue with it is that it's, at least in my opinion, it's very illiquid, right?
That's the thing. That's why I was asking his liquidity needs, because like with a single pay whole life, a lot of times you're getting 3 to 4% depending on the company, but you're going to have some implications if you take it out within a certain period of time, right? So that's why you gotta be careful. It depends on how soon you might want it. It's like always a specific need.
Are y'all talking about like infinite banking concepts, like banking through your whole life insurance policy kind of stuff? Okay.
Yeah, I mean, I for example, just like to share one of my strategies is I have a pretty sizable whole life policy that after about 5 or 6 years, I think, I'll be able to borrow from it. And even if I never paid back any of it, it has a high enough guaranteed IRR to never default, right? So it's like I could do that in an emergency. Say I wanted to, like there's a great opportunity, like you were talking about, Carsten, like here's a great opportunity for me to put some money into something. I could borrow 40 grand against it, and then I would never worry the policy would go away.
Yeah. I want to learn more about banking through a whole life insurance policy because it seems super interesting. You have to be careful with life insurance. People selling you them are really trying to screw you. They charge high fees. There's the liquidity.
Normally they don't know what they're doing, to be honest. I sold insurance for a while, and there's like so many people who do know nothing. I knew nothing when I started, to be honest. So yeah.
Okay. Yeah. Well, interesting. Right on. Yeah. So you have to be careful. I mean, my firm generally isn't into that, and we recommend people get term insurance. Just get like a 30-year, 40-year thing just to protect your family if you get hit by a bus and you're the one making money. Something like cheap and easy. But I know smart people like the whole life insurance policy strategy. So there's something there.
It's a very good tool for wealth transfer because it's tax-free wealth transfer.
Well, that's a helpful thing to look into. I want to open it up for anyone else, like pose any kind of financial question. Like we're all here to help.
What would a good alternative be to high yield savings accounts if you have more than like $10,000 in it? So if BlockFi, only gives you that benefit at up to a certain amount, like what would you recommend for someone like saving up to buy like a big purchase that can earn more than 0.5%? Because I didn't even know, like I said, I just opened one a few months ago because it was just what people told me to do on YouTube. Like if you're just sitting on cash while you're saving up for something, put it in a high yield. So just throw it in there while you wait. And I feel like I felt pretty smart making that move. So now I feel kind of dumb hearing that like it's a pretty stupid or a pretty worthless endeavor. So like what would be the recommendation or the alternative?
Well, I should clarify because I was probably too brash. Like if you're saving up for something specific, I think that's fine. Like if you're planning on holding that account for like less than 12 months, just to put a number on it, that makes perfect sense to me. Just hold it in cash so that the cash is there to buy whatever you're buying. I mean, is that what you said? You're looking at buying something?
Right. I'm holding it for about 12 months or less.
Yeah. So I think that makes perfect sense. I mean, alternatives, I don't know. I mean, everything has its own risks. don't tell my bosses this, but I kind of like gold for that, because if the stock market goes down, or crypto, really, crypto is just more volatile, but if the stock market goes down, gold usually goes up, precious metal usually goes up. And then I'm just buying, say, my condo or house or whatever it is with, I'm selling a real asset, the gold, and then I'm buying a real asset, the condo. And it just seems like a natural kind of transition. But less than 12 months, I think cash is fine. Selling some stock is fine. It's hard to say what you could, I mean, the stuff where you can get 10% on crypto is crazy. And I'm not as familiar with it as you guys are. Like, that sounds pretty nice. But other than that, I mean, there's no easy way to make that much, to get more than a few percent. You know what I mean? It's a unicorn these days.
Yeah, and I'd push back a little bit at so your time horizon matters a lot, but now like 12 months used to not be a long time. You used to only lose 3%, but now you're losing effectively like 10 to 15% over a 12-month period. So for me, it's like I have almost no cash, because I'm like, why would I have any cash if I can park it in a stable coin equivalent and throw it into a lending protocol and get 10% yield or 7% yield? Well, then at least I'm only losing 7% instead of losing 15%. It like
You say
hurts a lot less.
lose to inflation?
In terms of like the amount of assets that you can purchase with your money. Yes, that's called asset inflation.
Talking about
Like,
opportunity cost, right?
in a way, like what I'm trying to get at is like the price of bread isn't like increasing by 15% a year. At least it doesn't feel like that yet. But the amount of real estate you can buy is decreasing by 15%. The amount of stocks you can buy is decreasing by 15%. The amount of crypto you can buy is decreasing by 50%. So, like, to me, cash really sucks right now. And I can't accept 0.5%. It has to be in something that's going to do better than that.
I mean, that's fair enough. I mean, anything other than cash, it zigzags, but cash, is going down. So when I say there's no guarantee of getting more money, it's just that anything that's going to get you more money is probably more volatile. And if you need the money to buy something like a house or whatever it is, it might make sense to just be reliable and back down to cash. But yeah, maybe you're right. Maybe 12 months is too long. Maybe that's the answer for 3 to 6 months or less.
Okay, and then to follow up, then if 12 months is too long, maybe in Nick, what would those areas be that you would place your money in instead of high yield? So you mentioned like BlockFi. Are you doing that actively? Because I know there's limits to the amount. You just like split it between all the different services until you hit the cap on all of them, or
BlockFi and Celsius and all these other companies, they only have limits, to my knowledge, at least meaningful limits on like Bitcoin and Ethereum. I'm pretty sure that 10 grand isn't going to trip any wires. So you'll be able to get 7 to 10% yield. Now, again, like what you're accepting, that you're moving further and further out on like the risk curve in order to get that. So you're accepting counterparty risk, but I mean, these companies have been around for years at this point, and they have like billions in assets under management. So it feels kind of safe. And then the alternative is to use a decentralized lending protocol, a DeFi protocol. And there's tons of different ones. There's more than a dozen. There's dozens and dozens that you can use to get somewhere between 7 and on like the ridiculous far out on the risk curve, like 30% yield on stable coins, which is nuts. But just like do your due diligence and your research. But yeah, if it's a year, I would not keep it in a savings account personally.
Cool. Thank you guys for the perspective.
I think one thing it would be maybe helpful for, I think this pretty well, Nick, I'm assuming. Is there a lot of people here who are familiar with what 1031 exchanges are?
Yeah, in principle.
You know about it, right, Nick? So do you want to explain it to most people? Because I feel like a lot of people might not be familiar with that.
Sure. Totally. So the basic idea, and I'm not an expert in this. Logan is actually talking to his real estate agent about potentially using a 1031 exchange. So maybe Logan, do you want to chip in?
Sure. Yeah. My understanding, on a high level, I only know of its use in real estate. I'm pretty sure it can only be used in real estate, but basically, it's an agreement that the government made with real estate investors that says you can defer your taxes on properties you sell as long as you're putting that back 100% into more real estate. And the idea is that down the road, you'll be able to pull out at any point. And when you pull out, then you'll take that massive tax hit. One advantage to that, though, is that you can escape it by dying, and that burden doesn't go on anyone else in your family. All of the assets that you own after you die would just get passed off to whoever you have addressed in your will. So it basically is a way to avoid paying taxes on all your real estate capital gains, as long as you're putting 100% of that money back into more properties and just living off the cash flow. So it is a pretty powerful tax. I guess you call it a loophole, but it is built into the law. There is probably going to be a limit on it, which will be instated pretty soon here by the Biden administration. I think it's capital gains per property, I believe, over $500,000 will not fall under the 1031 exchange. So it could change the investment strategy, but early on, if you're investing in real estate, you can use a 1031 exchange to basically not have any taxes on the capital gains, so long as you're investing all of that back into more properties.
Yeah, I just emphasize, like, keep an eye on it for the law changes, because I agree with you. It's going to happen pretty soon. They're going to change those a little bit.
Yeah, I also want to just like speak to this idea that kind of blew the fuck out of my mind about the value of getting leverage when investing in real estate. So if the US dollar is entering a new paradigm where we just kind of print trillions and trillions and trillions of dollars every single year, and the real level of asset inflation, we just assume it's like 10%, you get a 30-year mortgage and you decrease like inverse compounding almost. You decrease the value of the dollars that you pay back on a fixed mortgage by 10% every year for 30 years. Just to throw bullshit numbers into the air to illustrate the point, let's say your mortgage payment is it's $2,000 a month. It's $2,000 a month today, and it's $2,000 a month on May 2051. But by the time May 2051 comes around, it feels like $200 a month, $10 a month, something absurdly low, right? So just like the fact that if you can borrow money on extremely long terms at a low interest rate, you're scamming basically whoever is lending you the money, because they'll never get the effective value back.
Yeah, that's a really great point. The only risk you run into there is possibly if there was a massive deflation through like a whole bunch of default, like massive institutions defaulting on their books, but that doesn't happen almost. Like when it does happen, the government just prints a fuckload of money.
Yeah, the government it prints the money and then it makes it worse. The only thing like a global debt jubilee, or I can't even, some total black swan.
I mean, that's what happened in 2008. Was there was a massive deflation initially until they pumped the money out, right? Then it just essentially fixed it. So it was just like sideways until they started spending the money. But again,
yeah,
it's like
they're not going to let it deflate. Is what it amounts to. That, you know, if it ever starts deflating like that, they're just going to rev up the money printer until it doesn't deflate like that, you know.
Yeah, my point is basically that it's quite low risk. So I agree with Nick. I think it's a great idea.
Yeah, I'll emphasize that too. Like, it's one of the best hedges against inflation to borrow a lot of money at these low interest rates, whatever way you can. And yeah, I mean, we're just in this special circumstance where we live in the global empire that controls the most powerful currency ever. And while every other currency eventually collapses and hyperinflates or turns into some kind of mess, I think the fact that that the US controls the world boosts its currency immensely. And I do think there is some small risk of deflation, and so we'll see, because that would change everything from the way it's been the last 100 years.
So I want to open it up again. Anyone have any kind of like wealth related questions or challenges, or you're looking for help with strategy? How can we help you guys?
I have a question for Carsten. What is the biggest thing that you see young people doing that prevents them from building wealth when they're older? I know you don't manage or do a lot of business with young people and I'd say people my age. But just from your knowledge and experience, what would you say that is?
Yeah, well, and a lot of our clients have kids, and so we do see a lot of that. Plus, like, me and all my friends are in kind of our general situation. Man, I mean, thinking about it, it's kind of the opportunity cost of not setting up those retirement accounts we talked about, like a Roth IRA. Just like everyone, if you don't know what that is, I would say, like, right after this, Google it, open an account somewhere, just set one up. And if you make, I mean, there's some basic rules you can read about, but people who don't do that are losing out on a lot of money. They're paying a lot more taxes than they have to. And I see that a lot. I mean, I was actually exactly that person. Like, I could have set one up at age 18, or my dad could have set one up for me, and just started putting, a couple thousand in every year, or whatever you're able to put in. That's a big one. The other thing is just spending beyond your means. Like, people just kind of have this attitude like, oh, I make it so I can spend it. And I'd say just be methodical about saving a little bit every year, and not spending everything you make. I mean, I think that's a big one too. I'm curious, some of y'all might have some other like good ideas about that.
Yeah, like I put in the chat, I feel like a huge roadblock for young people is just not taking the time to self-educate. It's critical. Like there's no one that's just going to hand you all the information on a silver platter. It has to be found, but it's like really easy to find if you're willing to look. So that's my 2 cents.
Yeah, there's so much information. Like, I got very lucky that I had a mentor who taught me all this stuff. Like, when I sold insurance, right? If I had not had that direction, I would have not known where to look. So I would probably recommend, like, the people in this group, probably a lot of us know, if you really don't know, don't be afraid to ask. Like, we'll give you like direction on where to start looking and reading and educating yourself, or how to find the right mentor. Like, to me, that's huge, right? Finding the right person who actually knows their shit is really hard, but once you find them, like, it's so invaluable.
Could you suggest where to start looking for this stuff, like any books to read or anything like that?
I mean, my favorite one to start would be The Richest Man in Babylon, because it gives you the idea of like what you need to understand for the basics. And then there's a couple other ones, like I'd recommend Rocking Wall Street, but only the first half, because the second half is him pitching his plan. And then there's a couple other ones I can pull them up from my list and put them in the chat.
First one that I ever read was Rich Dad Poor Dad, and that's what really started getting me really, really into this and really passionate about it. So that's what when I try and get my friends into this, that's what I recommend they read. And I really enjoyed that book.
So I've got a question, Carsten, maybe you'd know, or maybe everyone else in the group has heard things. So you mentioned this concept of like borrow money while there's low interest rates. And I've heard of like certain like government loans that can, if you have an LLC that's like generating revenue, you can apparently like borrow money on like a 15-year term at like a 1% interest rate. And I'm sure that there's like just weird niche examples, stuff that I would never know, but I am very interested in learning like what are some alternative options for like borrowing money outside of just getting a mortgage on a property?
Well, there's the crypto thing that some of y'all apparently know a lot about. Borrowing money against crypto.
Yeah.
Real estate, I think, is probably the most natural way that just happens all the time. Like, you buy a house, you buy a condo, or maybe you already own some property and you can take a loan out on something you already own. I think that's great. Besides that, I mean, if you have a big enough stock account, you can borrow money against your stock. But that's something that, I mean, I don't think, I mean, I'd be surprised if any of us were there. Maybe some of us are, but if you have a big enough stock account, you can take 90% out. Whereas like if your stock account's valued at $1 million, you might be able to take out 5 or 6 or 700 grand. Some bank might lend you that much money, and then your stock account is the collateral. So if you can't pay them back, they get your stock, but you know, that gives you a bunch of extra cash that you can go buy property with or invest with or buy Bitcoin. But I don't know. I mean, real estate, I think, is the most natural way to get loans, especially for young people. Like try to buy some property, put 5% down, get a 3% interest rate. It's pretty good.
So I'm going to do for my first house in Austin. Cool. So my tax guy told me about an EIDL loan. It's a new loan that came out of some kind of COVID relief bill. It's like economic injury, disaster, something. And apparently if you had an LLC in 2020, then that's something that you can borrow money against. And it's like stupid, artificial, low stuff. But I'll speak super briefly. Like I am paying for my down payment by using a collateralized loan against some of my Bitcoin. I use a company called Celsius, and they give me 25 grand. I give them some Bitcoin at a 4-to-1 LTV. The 25 grand can serve as the 5% down payment on the house. And so I get to pay for the down payment on a loan with a loan. And all of it's like non-taxable events, right? So in 3 years, I have to pay back that 25 grand with 1% interest, but that's like not bad at all. It's 1%. So that's Celsius, and that's the power of like what you can do with crypto.
Damn, that's crazy.
Yeah. So like once I figured that out, I was like, am I stupid? Am I missing something? And it's like, nope, it's actually that easy. So I was hoping there might be more ways to borrow money. EIDL loans, if any of you have an LLC, might be something to look into.
Yeah, there's a couple like special programs for COVID for businesses like that one that are incredibly, I mean, it's just helicopter money. It's just the government like giving away money, but take advantage of it. I mean, if you're involved in a business, I don't know enough about it to really preach on exactly what you could do, but that one, EIDL is one. And of course the PPP stuff that people were doing over the last year, where the government was basically loaning businesses money based on how much they're paying their employees. And then you end up not having to pay the government back. They just forgive the loans. And so it's just free money for businesses.
It's completely insane. So we're coming right up on time, technically speaking. But Carsten, if you're down, you want to just like hang out for a little bit?
Yeah, absolutely. I'm chilling.
Sweet. Cool. So what we'll do is we'll go ahead and kill the recording, and then the rest of it's just hangout time.